You think you have $1 million in your 401k. You don't. The IRS owns a slice, and they get to set their percentage later. At a 22% rate, your million spends like $780,000. At 32%, it's $680,000. At 37%, $630,000. At 45%, just $550,000. That's not a typo. Here's the thing most people miss. A 401k is a tax-deferred IOU. You're trading a known tax today for an unknown tax on a bigger number later. I'm going to show you how policy in 2026 RMDs and Medicare rules backload your tax bill and what to do next. If you plan your retirement around a $1,000 headline balance and forget the after-tax reality, you're building a budget on funny money. The consequence is brutal. You think you can fund 25 years of spending, but $300,000 to $450,000 of that balance belongs to the government. Flexibility dies. Travel, home repairs, gifting, everything gets smaller because every withdrawal drags tax with it. Let me break down what's actually happening behind the scenes. In a traditional 401k, the IRS is a variable percent co-owner. Today you get a deduction, sure, but you didn't avoid tax, you delayed it. You deferred at a known rate now to pay at an unknown rate later on a larger base. Meanwhile, lawmakers can change brackets, deductions, and thresholds. Your silent partner writes the rules after you've done the saving. Now the math that should make you sit up. A $1,000 pre-tax balance is not $1 million in spendable dollars. At a 22% rate, you're effectively holding $780,000 after tax. At 32%, $680,000. At 37%, $630,000. At 45%, $550,000. Same portfolio, same investments, different tax rate, radically different lifestyle. And as your account compounds, the government's claim compounds too. You're not just compounding your wealth, you're compounding the future tax bill attached to it. The thing most people miss is the flip in compounding. Deferring tax sounds efficient because my money grows tax-deferred. But the untaxed portion isn't yours yet. When you wait, you're letting potential taxes ride the market with you. If future rates are equal or higher, you financed your partner's cut with your returns. That's the absurdity of this arrangement. Here's the shortcut nobody teaches. Stop thinking in pre-tax balances. Think in spendable dollars. If you're planning from a spreadsheet, add an after-tax column next to your current balance using your realistic marginal rate in retirement, not your average. Marginal matters because it's the rate on the last dollar you withdraw, the one that sets your real spending power at the margin. Let me give you a micro example. Two households each show $1,000 in a 401k. Household A will depend on withdrawals plus 2 Social Security checks. Household B has a pension too. Household B's extra guaranteed income pushes their withdrawals into a higher bracket, so the same $1,000 buys fewer groceries. It sounds impossible, but I see it all the time. Identical balances, different tax results. Common mistakes make this worse. Assuming you'll be in a lower bracket in retirement ignores how required withdrawals and benefits stack. Ignoring state taxes turns a 22% plan into a 27% reality. Forgetting the Social Security tax thresholds means each extra dollar can pull more of your benefit into taxable income. Your marginal rate jumps without warning. Once you start measuring purchasing power instead of account size, everything else clicks. You choose contributions, conversions, and withdrawal timing based on the after-tax cash that hits your bank, not the feel-good headline number on your statement. But here's where it gets really sneaky. The rules aren't neutral. Recent law changes deliberately load the tax bill into your 60s and 70s. There's a window where taxes are effectively on sale, and then mechanisms that force you to pay up whether you need the money or not. We'll hit that next. Now let's talk about the rule change that catches late savers off guard. Starting in 2026, if your prior year FICA wages from your current employer are above roughly $150,000, Your age 50 plus catch-up contributions can't be pre-tax anymore. They have to be Roth. That means upfront tax on the catch-up dollars, $8,000 standard or $11,250 if you're 60 to 63 under the enhanced limit. For high earners, this flips the script mid-career. More tax now, less deferral later. And if your plan doesn't even offer Roth, no catch-ups at all until they add it. But here's where it gets really sneaky. Your regular deferral limit, $24,500 in 2026, can still be pre-tax. Only the catch-ups get forced to Roth for high earners. So a lot of people end up with a hybrid, pre-tax base Roth catch-up. If you're not planning cash flow and withholding, this creates underpayment penalties because your tax bill suddenly rises on those catch-up amounts. The IRS isn't confused about your new taxable income. Your paycheck is. Let me break down what's happening behind the scenes. Lawmakers pushed more Roth treatment into the system to collect tax revenue earlier and reduce future government liabilities from RMDs. You can like or hate the policy, but the effect is clear. If you're a peak earner, your Save More button now comes with a higher current year tax cost. If you do nothing, you'll feel it when your refund shrinks or a penalty letter shows up. So what do? First, confirm your plan actually has a Roth option turned on for 2026. If it doesn't, catch-ups are off the table until they fix it. Second, model your tax bracket before you set contribution elections. If your marginal rate is already stretched, consider maxing the regular pre-tax $2,400 to reduce AGI, then let the catch-up dollars go Roth as required. Third, adjust withholding or estimated payments now. An extra $8,000 taxed at 32% to 37% is thousands in additional tax. Don't let that surprise you next April. Here's the twist most people miss. With current individual rates made permanent under recent law, today's brackets are relatively low by historical standards, especially if you've got deductions. That means taxes are on sale compared to possible future rates you'll face when RMDs kick in. Paying a fair price today on purpose can be smarter than paying an unknown price later by accident. The Roth catch-up mandate, annoying as it is, can be turned into an advantage if you coordinate it with conversions and your withdrawal strategy. And the game changer nobody talks about, employer contributions remain pre-tax. If you're a business owner or you get a strong match, those dollars still land in the tax-deferred bucket. In other words, even as catch-ups go Roth, you can keep stacking employer money pre-tax while directing your own contributions strategically. Owners with solo 401ks also have room to maximize total plan limits while planning the Roth versus pre-tax mix intentionally. Quick micro story. A late career saver earning above the threshold realized their 2026 catch-ups would be forced Roth. Instead of reacting in April, they increased payroll withholding in January, maxed the $24,500 pre-tax deferral to keep AGI in check, and let the $8,000 catch-up hit Roth. They also ran a simple bracket model and avoided a penalty. Same contributions, fewer surprises, and better tax diversification. Once you understand the 2026 shift, you see the window. Use relatively low rates to pay tax on purpose when it fits your plan, not when the system forces you. Which brings us to the enforcement arm of this entire arrangement: required minimum distributions. RMDs are the mechanism that turns deferral into a bill. Starting at age 73 for most, and later for younger cohorts moving towards 75, the government forces you to withdraw a percentage of your pre-tax balance whether you need the money or not. Roth accounts and employer plans don't have pre-death RMDs anymore. Traditional balances do. That's the distinction that matters. Here's the math that stings. A $1,000 pre-tax balance at 73 comes with an initial RMD of roughly 3.6%. That's about $36,000 of taxable income added to whatever you're already receiving from Social Security, pensions, and investments. That extra income doesn't just fill your bracket, It also changes what else becomes taxable. Social Security has a nasty interaction. As your provisional income rises, more of your benefit becomes taxable. Each extra dollar can pull more of your Social Security into the tax base. That's the tax torpedo. Your marginal rate spikes higher than the bracket table suggests. But here's where it gets really sneaky. Medicare premiums through IRMA look back at your modified adjusted gross income. Cross certain thresholds and your Part B and Part D premiums jump. It sounds impossible, but I see it all the time. A small extra distribution tips you over a line. Your healthcare costs rise for the whole year. You didn't change doctors, you didn't get sicker, you just drew too much from pre-tax at the wrong time. Key takeaway: your 401k defers tax into a future you don't control. 2026 rules RMDs and turn a big balance into a big back-end liability. Subscribe now. Part 2 drops next with the exact escape hatch sequence. How to prioritize pre-tax versus Roth, model brackets, and convert without tripping avoidable penalties or Medicare surcharges.